If you bought silver this morning because you saw the headlines, I have some brutal news for you. You were the exit liquidity. You got played. And in the next few minutes, I'm going to show you exactly how it happened so you never fall for this trap again. Wednesday, January 7th. The financial world woke up to a bombshell. Bank of America, one of the most powerful institutions on the planet, released a research note predicting silver could hit $300 an ounce. $300. The headlines were everywhere. Twitter exploded. Financial blogs went crazy. Your inbox flooded with alerts, and retail investors, people like you and me, looked at that number and panicked in the best way possible. They thought, this is it. The rocket is leaving. I need to get in right now before I miss the ride of a lifetime. So they rushed in. Money poured into silver. The price surged from $81 all the way up to $82.75. It looked like a breakout. It felt like the beginning of the run to triple digits. Every instinct said you were early to the party. And then, without warning, the floor disappeared. The price didn't just stop climbing, it collapsed. We went from $80.75 down to $78.54 in a matter of hours. That's a $4 drop. If you bought at the top, you're sitting on a 5% loss in a single afternoon. Your stomach is churning, your hands are shaking, and you're asking yourself what the hell just happened. What happened was one of the oldest tricks on Wall Street. It's called selling the news. The smart money used that bullish headline from Bank of America as cover to dump massive positions onto excited retail investors who were chasing the hype. While you were buying, they were selling. While you were celebrating the breakout, they were celebrating their exit. You provided the liquidity they needed to get out of their trade. This wasn't an accident. This wasn't bad luck. This was a strategic wealth transfer, and you were on the wrong side of it. Now, before you close this video thinking you already know what happened, let me tell you something. This goes deeper than you think. We're going to dissect exactly why major banks issue bullish forecasts right at market tops. We're going to look at the dangerous technical pattern that just formed on the chart, something called a double top that suggests we might fall even further. We're going to talk about how whale traders exit massive positions without crashing the market before they're done selling. And most importantly, I'm going to show you how to survive this volatility without losing your position or your mind. The headline said 300. The chart says 78. You need to know which one matters. This is the story of the Wednesday flush. To understand what happened today, you need to understand how a whale exits a trade. Imagine you're a hedge fund manager. You bought millions of ounces of silver back when it was $60. Now the price is at $80. You're sitting on enormous profits. Life is good. You want to sell and lock in those gains, but you have a massive problem. Your position is so large that if you just hit the sell button, your order would crash the market before you could get out. It's like trying to sell 1,000 cars in a small town. If you dump them all at once, prices collapse, and you destroy your own profits. You need buyers. You need millions of buyers to step up and take your bags so you can exit cleanly without crashing the price. So how do you find millions of buyers all at once? You need a catalyst. You need a story so exciting, so compelling, that retail investors rush in without thinking. You need a headline that makes people feel like they're going to miss out on the opportunity of a lifetime. Enter the Bank of America research report, silver to $300. Now, I'm not saying Bank of America deliberately coordinated with hedge funds to create this situation. That would be speculation. But what I am saying is this: whether by design or coincidence, that report created the perfect liquidity event. When retail investors read that headline, they flooded the market with buy orders. They created a massive wall of demand at $82. And the institutional sellers, the hedge funds, the whales, they looked at that wall of buying and they said, thank you very much. They sold into that strength. They used their excitement to absorb their selling pressure. They offloaded millions of ounces while you were celebrating. This is why the price crashed the moment the news went fully viral. The smart money was distributing their positions to the late money. It's a tale as old as markets themselves. Buy the rumor, sell the news. The rumor was the breakout. The news was the $300 target. And the result was the crash. This is lesson 1. Headlines are often the weapon, not the information. When you see a major financial institution issue a bullish forecast right as prices are peaking, you need to ask yourself, who benefits from me believing this right now? The answer is usually someone trying to sell to you. Now let's talk about the technical damage because this matters. Charts have memory. Traders remember where they lost money before. If you look at the silver chart from last week, something interesting happened on December 29th. That was during what traders call Ghost Week, the dead zone between Christmas and New Year. It's when trading volume is thin and prices can swing wildly. During that week, silver spiked violently to $83.71 before getting absolutely crushed. That was rejection number 1. The market tried to break above 83 and failed hard. Today, January 7th, we rallied to $80.275. We got within $1 of that previous high. And once again, we got rejected. Once again, massive selling pressure appeared and pushed the price back down. In technical analysis, this creates what's called a double top. It's a pattern that looks like the letter M when you chart it. It's one of the most feared formations in trading because it tells you something critical. There's a wall of sellers defending that $83 level. Every time buyers try to push through, sellers step in and smash the price back down. Think of it like a medieval battle. The 83 level is the fortress wall. Twice now the attacking army has tried to breach it. Twice they've been repelled by the defenders. Each failed attempt strengthens the psychological barrier. Now every trader watching this market knows that 83 is dangerous territory. They remember getting burned there. So the next time price approaches that level, they'll be even quicker to sell. This creates a self-reinforcing cycle of resistance. The double top tells us that until we break decisively above 83.71, we're not in breakout mode. We're stuck in range-bound mode. The top of the range is clear. It's 83. The bottom? Well, we're about to find out where that is. Here's the brutal truth. If this pattern plays out according to the textbook, the price could retreat all the way back to what's called the neckline. In this case, that's somewhere around $70. That's a long way down from where we are now. That's why you're seeing panic on social media right now. Technical traders are screaming, sell, because the pattern says we're going lower. But before you panic, understand this. In markets driven by fundamental shortages and inflation, technical patterns often fail. A double top can transform into something else entirely. Instead of crashing to 70, the price might just go sideways. It consolidates. It forms what's called a handle. It digests the supply, burns out the sellers, and then when everyone least expects it, it rips through that 83 level like it was never even there. I believe we're forming a handle, not a top. Why? Because of the volume. Look at the volume on today's sell-off. Yes, it was high, but was it panic high? No, it was profit-taking high. It matched the volume on the way up this morning. Now look at what's happening at the bid. Every time the price dips to 78.40, it bounces. We're currently sitting at 78.54. We're not crashing through the floor, we're sitting on it. This tells you something important. There are passive buyers sitting at $78, big buyers, patient buyers. These are the institutions we'll talk about later. They didn't chase the price at 82. They waited. They let the emotional traders flush the price down to them. And now they're quietly accumulating millions of ounces at a discount. When you see high volume, but the price refuses to go lower, that's accumulation. The metal is changing hands. Weak hands are giving it to strong hands. And strong hands don't sell. They hold for the next leg up. This is lesson 2. Volume tells you who's in control. High volume with a sticky price means the sellers are exhausted and buyers are absorbing everything. Now we need to talk about gold because silver doesn't trade in isolation. If you want to understand silver, you must first understand its relationship with gold. Silver is gold's rebellious younger sibling. Gold is the steady parent. Reliable, mature, moves slowly and deliberately. Silver is the emotional teenager. Dramatic, volatile, overreacts to everything. Today, gold dropped $32 to $44.53. That's less than a 1% decline. It's basically a flesh wound. Gold is still trading near all-time highs, still in a powerful uptrend, still fundamentally strong. Silver, meanwhile, dropped 3%, 3 times harder than gold. Not because silver's fundamentals got worse, but because silver is inherently more volatile. Traders call this high beta behavior. When gold catches a cold, silver gets the flu. When gold stumbles, silver falls off a cliff. But here's the critical insight that most people miss. Silver cannot enter a bear market if gold remains in a bull market. It's physically impossible. Think of it like a dog on a leash. The dog can run ahead excitedly or lag behind stubbornly, but it can't go in a completely different direction than the owner. The leash keeps them connected. That leash is what traders call the gold to silver ratio. Right now, that ratio widened slightly from 56 to 57. This means silver got cheaper relative to gold. And when silver gets cheap compared to gold, sophisticated algorithms and professional traders step in. They arbitrage the relationship. They buy silver and sell gold to capture the spread. This creates a natural floor under silver prices. As long as gold remains strong, silver has support. So when you see today's price action, recognize it for what it is. An emotional overreaction by the teenager while the parent remains calm. The parent is fine. The kid is just throwing a tantrum. Gold's strength is silver's safety net. And right now, that net is holding firm. We need to address the elephant in the room. Why would Bank of America, historically one of silver's biggest enemies, suddenly publish a bullish $300 target? To understand this, you need to know some history. For years, Bank of America held one of the largest derivative short positions against silver in the entire financial system. They were the hammer that kept prices suppressed. They told their clients that silver was just an industrial byproduct with no real value. They told them to stay away. In the silver community, Bank of America was known as the Death Star, the ultimate villain working to keep prices down. But yesterday, something extraordinary happened. The Death Star fired its laser in the opposite direction. They released a report authored by their commodity strategist, Michael Whitmer. This wasn't just an upgrade. It was a complete ideological surrender. They acknowledged three things that banks have denied for decades. Admission 1, supply is structurally broken. The report admits that even if prices rise dramatically, miners cannot quickly increase production. The shortage isn't temporary. It's baked into the geological and economic reality of mining. You can't just turn on new silver mines. They take 7 to 10 years to develop. This destroys the classic economic argument that high prices will bring more supply. Not this time. Not in silver. Admission 2, solar demand is accelerating beyond control. For years, banks claimed that engineers would find substitutes for silver in solar panels. The report admits this hasn't happened and won't happen. The green energy transition is consuming silver faster than we can extract it from the ground. This validates what many of us have been saying for months. The industrial demand story is real, and it's growing. Admission 3, silver has a monetary premium. By linking silver's price movement to gold's breakout, they're acknowledging that silver isn't just an industrial commodity. It's money. It trades based on inflation fears, currency debasement, safe haven demand. This is a total capitulation by the banking establishment. Now, here's the cynical question we have to ask. Why publish this report now? If Bank of America was massively short silver, wouldn't they want to talk the price down? Absolutely, unless they're no longer short. The most logical explanation is this. They flipped positions. During the ghost week volatility in late December, when prices were whipsawing and retail traders were panicking, the bank likely used that chaos to cover their short position. They exited their massive bet against silver. And now that they're out, or worse, now that they're long, they want prices to rise. They've switched teams overnight. They went from suppressors to promoters. This explains the violence of January's rally. This explains the sudden bullish research. They're front-running their own narrative. And while this seems manipulative, because it absolutely is, it's actually incredibly bullish for silver holders. Why? Because you want the banks on your side. When the largest financial institutions start positioning for higher prices, capital follows. Think of it like a dam holding back a river. For years, the dam prevented water from flowing downstream. Now the dam has been removed. The river is free to flow. This is lesson 3. Watch what they do, not what they say. The research note is noise. The position change is the signal. When a major financial institution publishes a specific price target like $300, they're not just making a prediction. They're changing the game board. Before this report, if you told someone at a dinner party that silver was heading to $300, they'd look at you like you'd lost your mind. You'd be dismissed as a conspiracy theorist, a crazy person living in a fantasy world. But now you can say, well, Bank of America thinks it could hit 300, and suddenly you're credible. You're citing institutional research. You're no longer the crazy one, you're the informed one. This is what psychologists call anchoring. The $300 number is now planted in the collective consciousness of the market. It's the new reference point. Even if people don't fully believe it, it shifts their perception of what's possible. Suddenly, $80 doesn't seem expensive anymore. It seems cheap relative to $300. This psychological shift is critical for sustaining a bull market. You need the crowd to believe that prices can go much higher. You need them to suspend their disbelief. The Bank of America target does exactly that. It gives permission to dream bigger. But here's where retail investors make their fatal mistake. They confuse timeline with destination. Bank of America is talking about 2026 or 2027. They're making a multi-year forecast based on structural supply deficits that will take years to manifest. But the retail trader reads that headline and thinks it means next week. They buy with their entire portfolio expecting immediate gratification. When the price drops $4, they panic and sell at a loss. This mismatch destroys accounts. The thesis is long-term, the capital is short-term. The psychology can't handle the volatility. If you genuinely believe silver is going to $300 because of fundamental shortages, because industrial demand is exceeding mine supply, because solar panels are consuming millions of ounces, because monetary debasement is accelerating, then what does a $4 drop on a Wednesday matter? It doesn't. It's background noise, it's the market breathing, it's the volatility you pay as the price of admission to a secular bull market. But if you're trading with leverage, trying to catch intraday moves, that $4 drop obliterates you. Your position gets liquidated, your account gets closed, and you're left watching from the sidelines when the real move happens. This is lesson 4. Align your time horizon with your thesis, or the market will punish you. Conviction without patience is just gambling. Let's talk about where we go from here, because this matters. We're currently trading at 78.54. That's the immediate support level, the first line of defense for the bulls. This was the breakout point earlier in the week. If we hold here, it demonstrates incredible strength. It means we didn't even need to retest lower levels. But if we crack through 78, the next fortress is at 75. The 75 level is critical. This was the ceiling throughout December, the price that silver couldn't break above for weeks. There's a trading principle that says old resistance becomes new support. If the price falls to 75, it should bounce hard. Every algorithm, every bank, every serious trader has buy orders sitting at that level. If we break below 75, then we have a serious problem. That would invalidate the breakout. It would signal a failed move. It would open the door to a deeper correction, potentially back to 70 or even 68. But right now, we're $3 above that danger zone. We have cushion, we have buffer, we have room to wobble without breaking. Here's what I'm watching for confirmation that the bull market is still intact. The Friday close. In professional trading, amateurs react to daily price movements. Professionals watch weekly closes. All the intraday chaos, the spike to 83, the crash to 78, that's just noise. The trend is determined by where we close the week. We have 2 days left, Thursday and Friday. If we close this week above 75, the weekly chart will show a volatile but ultimately bullish candle. The algorithms will read this as trend intact, just consolidating. That's acceptable. That's normal. That's healthy. But if the bears manage to push the price below 75 by Friday's close, it prints a failed breakout on the weekly time frame. That would trigger technical selling and potentially start a deeper correction. So your focus shouldn't be on what happens tomorrow morning or Thursday afternoon. Your focus should be on Friday at 5 p.m. Eastern Time. That's the only number that matters. This is lesson 5. Zoom out. The daily chart is a liar. The weekly chart tells the truth. I'm going to give you a strategy now that will feel unsatisfying. It won't give you the dopamine hit you're craving. It won't make you feel like a master trader. But it's the strategy that preserves capital and positions you for real gains. The strategy is this: do nothing. Right now, the market is a blender. Prices are whipsawing. Algorithms are hunting stop losses. Emotional traders are panicking. Professional traders are setting traps. If you try to trade around this chaos, if you sell at 78 hoping to buy back at 76, you will almost certainly get whipsawed. The market will reverse the moment you exit. It's designed to maximize your regret. This is the dirty secret of short-term trading. The house always wins. The friction of transaction costs, the emotional toll of timing decisions, the spread between bid and ask, it all adds up to destroy your returns. So if you own physical silver, here's what you do. Step away from the screen. You're not in the casino. You're outside the casino. You don't have to bet on every hand. You already own the asset. Your job now is to let the thesis play out. Let the fundamentals work. Let the shortage manifest. Let the institutions accumulate. Your only job is to not panic yourself out of a winning position. But if you're sitting on cash, if you missed the breakout at 70, if you've been waiting for confirmation, this crash is your second chance. It's the market giving you a mulligan. Any price between 75 and 78 is a gift. You're buying a breakout asset that's retesting support. This is the lowest risk entry you'll get until the next major correction. Stop waiting for $60. That ship has sailed. The floor has risen. Recognize the opportunity hidden inside the crisis. While everyone else is panic selling, you should be calmly accumulating. This is lesson 6. Sometimes the best trade is no trade, and sometimes the best trade is the one that feels scary. Let me bring this all together because you need clarity right now. What happened today was a classic liquidity trap. Bank of America issued a report that created excitement. Retail investors rushed in with buy orders. Institutional sellers used that buying pressure to exit or restructure their positions. The price collapsed once the retail money was exhausted. It was cynical, it was ruthless, it was effective. But here's what didn't change. The supply deficit didn't disappear. Solar panels still need silver. Mines still can't produce more. Governments are still printing money. Gold is still in a bull market. The East is still draining Western vaults. The fundamentals that justify $300 silver remain completely intact. Today's price drop was a sentiment event, not a math event. And in the long run, the math always wins. Emotion is temporary. Mathematics is eternal. So here's my final verdict on the $300 target. It's not a question of if, it's a question of when and how. The path won't be a straight line. It will be a war. There will be days like today where you take shrapnel. There will be moments where you question everything. There will be headlines designed to shake you out of your position. That's the price of admission to life-changing returns. The weak hands sold today. They got shaken out by a $4 drop on the road to a $220 gain. They'll watch from the sidelines when the price breaks 100, 150, 200. They'll tell their friends they used to own silver. They'll talk about how they would have been rich if only they'd held on. But you're still here. You're still holding. You survived the trap. You didn't get caught? Now hold the line. Watch the $75 level. Trust the thesis you came here for. And remember why you started buying silver in the first place. This wasn't the end of the bull market. This was the moment that separated the tourists from the believers. This was the test that determined who actually has conviction and who was just along for the dopamine ride. The trap has been sprung. The weak hands are gone. The institutions are accumulating. The fundamentals are stronger than ever. And you're still standing. Welcome to the war. You just survived your first real battle. The question now is simple. Will you hold for the victory? Or will you give your silver to someone who will? The choice is yours. But choose wisely, because this opportunity won't come around again in your lifetime.